Hey, good day, everyone. It's Ronco Johnson, your lifestyle focused wealth coach. How are you? It's Lifestyle Focus Friday. Thank you guys for joining us. Listen, today we're going to just have a conversation. We're going to talk about it. You know, have you ever just had an opportunity to sit back, relax, and unwind with friends? Maybe you're having a glass of wine, or maybe even just having dinner, and you have these wonderful conversations that just go from one end of the room to another, and no direction, no reason, no rhyme, no reason, but it just happens. Well, today is going to be one of those conversations, and today we're going to start off talking about loan interest and income tax, rich versus the poor. And we've had this conversation before in a prior conversation, but it keeps coming up. And the way we think about our finances is one of those things that, you know, regardless of where we are, we're able to have this conversation over and over and over again. Hi, I'm Ronco Johnson, your lifestyle focused wealth coach. And today you're inside when the lights go out. Are you ready? Thank you guys for joining us. Hopefully you can hear us out there. But today we're just going to try things a little bit differently today. You know, we're trying out some new equipment and all the good stuff. And we want to just say, thank you for joining us. So we're giving you just a quick second to jump in the room because we've got good stuff to talk about as usual. So let's talk about what wealthy people do. And let's talk about the difference between loan interest and income interest. And we're just going to go ahead and jump right on into it. If you're joining us for the first time or the second time or whatever the case may be, do me a favor. Give me a thumbs up, put it into the comments, and we can talk to you about it. And who knows, we might even throw a little something else in there for you. I love to talk to you online, in person, while we're here, while we're live, and answer your questions that you may have. Because, you know, sometimes we have questions, and those questions are questions that everybody in the room may be wanting answered, and we don't want to leave anybody out, right? So in doing so, we don't want to leave anyone out. And because we don't want to leave anyone out, and there's no such thing to me as a bad question, right? It's just not. We want to make sure that everybody's feeling included and being here. So first of all, let me just say welcome back. And thank you for joining us. But before we get started, I want to make sure that we go ahead and get this house cleaning stuff taken care of before. If you are a first timer here, please, I want to say thank you. And I want to make sure that we sound off in the comments. If you got comments, put the word takeaways really quickly, put takeaways, and then put your comment. That lets us know that we're hitting home with something that we've talked about and something that we spoke about, and that you are engaged, because this is a program where we have to have your engagement. So sounding off in the comments is highly important to me, to us as a group. And then on top of it, here's the cost of admission. All you have to do right now is smash the like button, subscribe, and lock in right away. Let's do this now. Let's go ahead and share this with somebody who needs the wake-up call. And ring that notification bell. That way, every time we have some new content, that we can get it out to you. And you will never miss a drop of this wisdom that I'm dropping. And you can tell your family, you tell your friends. So this is more than just content, y'all. It's the blueprint for living free. And that's what we're having together. We're building this together. And I want to welcome you in. And for those of you who stick with us to the end, don't forget to go to the bottom and to the descriptions right below, right? And at the end, sign up for our weekly or bi-weekly email list, which contains articles, travel information, recipes, and a lot more. It's free to you for just coming and joining our Lifestyle Focused Wealth community. And I'm going to encourage you to join our Lifestyle Focused Wealth community online. It is where you really want to be. And joining it is really just about, hey, listen, do I want to be around people who are talking just like me? Do I want to be around people who are guided just like me? Are they having conversations that are in alignment just like me? Do I want to know more about what millionaires and billionaires do? Well, if that's the case, join our Lifestyle Focused Wealth community. It's just $16 a month when you pay the annual subscription. You can go to roncojohnson.com and sign up, and then you get to talk to me. You get to be around us. You get to talk to us, and then you have access. And something that I want to talk about today is access. When you have access, sometimes that's all you need. That's all you need. And so access can take you so far. And I was talking to one of my friends, my good friend. I don't know if she's on the line today, but let me just pop up and see. I know she's probably on the line. She's always here. And I'm looking at you guys from a different camera today. So please forgive me if I don't see your names in the chat, in the back chat. But I promise by the time this thing is over with, I'll be able to see it. But we were talking, and I was telling her that I got some information that I want to share in the future. So you got to stick around and find out what that is. So I got some information that I want to share with you guys and let you know that there's some great information coming ahead, and you're going to want to be a part of it. And I'm telling you, just by being associated, just by being able to be in the room, it's going to make all the difference to you in the world. All the difference in the world. And you're not going to want to miss that. I wish I can give you more details, but it's coming. It's coming. So, make sure you stay on and subscribe to our channel and at Ronco Johnson, and tell somebody that can use these financial tips that we're talking about. But today we're going to be talking about loans, the loan interest. Loan interest cost, and what that's all about. A lot of times when we have a conversation, especially when we're talking about it from a traditional sense, loans is a cost of borrowing money, and there's a cost to it. And typically it's expressed in a percentage of a loan or a loan amount, right? So it affects everyone that takes out a loan, whether it's personal, educational, whether it's business purposes, whatever the case may be, you're affected by that loan. But for the wealthy, the conversation is a little different. And what do I mean by that? What do I mean by that? How do you think the wealthy think about loans? Before I even get into that, put that in the comments. Do me a favor, go on down there and add your statement to the comments. Share this with your family, share this with your friends, post a comment down in our social media so I can see what we're cooking with today. But how do you think wealthy people see loans? I want to share with you. Wealthy people, for the wealthy, a loan can be a very strategic tool for leveraging investments and growing wealth. It can be a very interesting tool that can be leveraged to grow wealth. Hey, Sandy, what's happening? Happy Friday. Happy Friday to you. Thank you for joining us. For those of us who are in a lower income brackets, a loan can be what I call necessary means to access capital to take care of resources like housing, education, or emergency funds. So there are two different ways of you thinking about it. Just two total different ways. They think about it totally different. Well, income tax is also a little different. Let me put this in perspective. Income tax is a government levy. I think I'm saying that right. It's a levy on individual and business earnings. If you really think about it, it is a progressive tax, meaning that those with higher incomes pay a higher percentage of their earnings in taxes. So this system, it redistributes wealth and fund public services. However, there's an impact. And that impact on income tax, it varies. It varies significantly between different income groups, meaning how much is it going to charge you for the information that we're talking about. See, the wealthy have access to tax planning. See, they usually have tax professionals that you can sit down and talk about planning strategies and help them to minimize their tax burdens. And for those with lower income tax, they may find a large portion of their earnings taxed. See, access, going back to what I said earlier, having access, right? Having access is so important because when you have access to people that have strategy planning that can help you minimize the taxes versus those people who don't have access. Even though they make lower amounts of money, they have to pay more in taxes. That's relevant in today's economy. I hope that y'all understand. That is so relevant today. Why? Because more and more people are finding that our government and the way things are set up might not be for you. It may not have ever been intended for you. Or maybe you just feel uncomfortable about it and you start to think, RJ, well, what can I do? What can I do about it, huh? What can I do about it? So, I'm going to tell you what we can do about it. We could start to think about things like wealthy people do. Sometimes it's about how you position your mind to start transition your mind to think about the way maybe another class of people do. See, what I'm saying is, for the wealthy, high-income individuals often use loans to finance investments. They take advantage of low interest rates and maximize their tax returns. They also employ tax strategies all the time to reduce their taxable income. See, when you're using these strategies, such as investing in tax advantage accounts or utilizing deductions and credits, you usually come out ahead. Now, I'm not a tax professional, but I have friends that are. But that's how it really works. Is this information that should be stored away for just the wealthy? Or should you be able to use it as well? If you would like to use these strategies, you want to know more about these strategies, put it in the comments. Give me a thumbs up. Tell me that. Tell me that. And for the poor, those with lower incomes may rely on loans for essential needs. And those essential needs are a little bit different because high interest rates can lead to a significant financial strain. Stress in the family, stress on your income, stress on your body. Additionally, people with lower incomes may not have access, again, that word access, to the same tax planning professionals, to the same financial planning professionals. And that results in higher effective tax rates on their limited amount of income. Now, am I saying that's fair? No, life is not fair. Life is not fair. However, it is different. It is different, and these are some things that you might want to consider now that you're starting to think about our lifestyle-focused wealth community and start thinking how our individuals in this group are beginning to reshape and reset how we see things. Hey, Miss Henderson, what's happening? I see you out there in Milwaukee, Wisconsin. How's the weather? How's the weather? Hopefully it's a little warmer out there. So we're just going to talk about, we're talking about what loan interest and how income tax and loans are a little bit different. Loans versus income tax, the rich versus the poor. And how, in many ways, the truth has been hidden from us in plain sight. I'm saying it. I'm saying it. The truth has been hidden from you in plain sight. Well, what do I mean by that? It's pretty simple. I'm just saying that here's the truth. The wealthy have access to people who can help them minimize their tax payment. And the people who are what I would call middle of the way income, they end up paying more taxes, as I've already established, because they don't have access to these types of people. And a lot of times, that causes an issue. See, tax policies, the change in tax laws can impact disposable income for the average person very easily, and the ability to save and to invest. It does that simply because it varies in the effects on different economic groups. See, financial literacy is a piece of this puzzle that I really think we haven't talked about. And one of the parts that we really need to concentrate on, because see, financial literacy, understanding the interplay between loan interest and income tax can empower individuals to make better financial decisions. I'm telling you, regardless of their income levels, you deserve the opportunity to make better decisions. And with those better decisions, more informed decisions, you're able to look at this whole construct by examining how loan interest and income tax affect both the rich and the poor. And then we can gain insights into a broader economic trend and the importance of financial education and promoting it in our economic equality. That's really what we're all talking about. So if you have questions about the specifics of what my questions are, or some needs that maybe I'm not touching on, feel free to ask. Put it in the comments, and I'll be more than happy to tackle it for you. But I want to highlight a couple of things that I think are pivotal when it comes to understanding where we are in this movement. The main insight into the systematic advantages that wealthy people have over poor people is knowing how to manage loan interest and tax obligations. No, it's not the IRA. It's not the Roth. It's not the stocks and bonds and mutual funds. It's not even the product of life insurance. A lot of the time, the biggest enemy is the taxes that we pay. And it lies in their access to resources and the level of financial education that they absolutely have access to. And these financial strategies that can significantly reduce the cost of their tax liabilities. I have to be honest with you. This disparity creates a pivotal moment of understanding about economic inequality. You can't run from the truth. And all we're here to do is talk about the truth. There are systemic advantages for wealthy people all over the place. The game is played differently. And all we want to do is help you understand how the game is being played. You got me? Are y'all following me in the comments? I'm glad it's comfortable. I'm glad it's comfortable. It's comfortable here in Atlanta today too. So let's talk about those advantages for the wealthy for just a moment. Do y'all want to know those advantages? If you want to know those advantages, put a thumbs up in the comments. Put it in the comments. Let me know. Maybe I'm just giving you information, just giving it to you, and maybe you're undeserving. Maybe you shouldn't be getting this information. Maybe you want to go pay somebody to give it to you. Because when I tell people this for free, it's amazing how they just overlook how important these details are. I'm going to warn you, don't overlook the importance of this information. Why? Because it can be life-changing. Because access to lower interest rates are important. Wealthy people know that. Wealthy individuals often have better credit scores. And they get more valuable collateral, which allows them to secure loans at a lower interest rate. For example, they can leverage assets like real estate investments and obtain favorable terms on their HELOCs and margin loans and turn those into dollars that they can use as investable dollars. Tax deduction opportunities. See, the rich have more opportunities to take advantage of tax deductions and credits because typically they're business owners. They can deduct interest on mortgages. They got HELOCs they used on their homes for home improvement, or maybe they expanded the home, and margin loans used for the purpose of investments. And these deductions are significantly reduced. It reduces their taxable income. Why? Because they're not using income, they're using loans. And you might remember from earlier days, we talked about the difference between loans and taxable income. Well, earned income, you have to pay your taxes on. It could be as high as 43%. But wealthy people rather take a loan. It could be as high as 19%, 21%, 8%. But that loan is much different than paying tax on the income. So it's just depending on where you are, how you're looking at it, and how you reshift your mind. And that's what we're really talking about. We're talking about financial planning and advisory services. Wealthy people can afford to hire financial experts, and that helps them to optimize their financial strategies. This allows experts that can identify the best ways for you to minimize your tax liability. That's what we're being paid for. But for people who don't come from that background, they're really not even understanding why sitting in front of an advisor is so important. It's not about how much money I make you in the next 15 minutes. It's how much money we've saved you in your tax liabilities. How often do we talk about managing your debt? See, once we get to understanding tax liabilities and managing your debt efficiently, then it all starts to come into fold. See? Are you guys following me? Loans can minimize your taxes. Yes, Miss Anderson, yes, that's right. It minimizes your taxes because there's no taxes on loans. Instantly, there's your answer. There's no taxes on loans. You may pay an interest rate on a loan, but you don't pay taxes on a loan. So going back to what I was saying earlier, the truth, here's the truth. Investment leverage. Let's talk investment leverage. See, the wealthy can use borrowed funds to invest into high return opportunities. What I mean by that, further increasing their wealth For instance, they may have a margin loan to buy additional securities. So if you got a margin account, they usually multiply that times 4, whatever that money is. If it's 100,000 times 4, now you got access to 400,000 in this scenario. Well, the idea is for you to buy additional securities, stocks, bonds, mutual funds, so on. However, those dollars can be used to buy other things. You don't have to buy securities. Well, real estate is a security, but it's a different type of security. So that's benefiting both the investment returns and their tax-deductible interest just by using those loans at a lower interest rate and going elsewhere and buying things with a higher profit margin. Am I making sense to you guys? If it makes sense to you, put in the comments. Everybody put in the comments if that's making sense to you today. So another pivotal moment is making sure that we recognize that these advantages are not just about having more money, but it's about having access to tools and knowledge that can multiply wealth and reduce financial burdens. That's what this is all about. If we can multiply our wealth and reduce our financial burdens, I bet that's the ingredient to living longer. Why? Because you're not as stressed out. There's no financial burden. Maybe we can stay in our relationships longer. Why? Because we're not fighting over money. No financial burden. See, this increases a cycle. This creates a cycle where the rich get richer. Not merely because they have more money, it's because they can use their resources more effectively. And when they're using their resources more effectively, there's some things that I want to put out there that you should consider. Consider two individuals, one wealthy and one with a lower income, right? Let me give you an example. If you were to consider these two different individuals, see, the wealthy individual takes out a HELOC, a home equity line of credit, at a very low interest rate to renovate their home, increasing its value and deducting the interest from their taxes. Meanwhile, the second person, the lower income individual, takes out a high interest personal loan for emergency, right? Just for emergency expenses. There's no tax benefits to that. And a higher financial burden goes with that. See, this disparity once again highlights what I'm saying. It highlights the systemic advantages that perpetuate economic inequality. See, by understanding these dynamics, we can better advocate for policies and practices that promote financial literacy and equitable access to financial resources for all people, not just the powerful, not just the wealthy. Man, you really got it. If this is hitting home with you, please put it in the comments. Give me a thumbs up. Let me know. Let me know. I feel like I'm talking to myself today. But I know that I'm not. I know that what I'm saying to you, there's a value in what I'm saying to you right now. And the value is so great that a lot of times we just don't want to think about it. We just don't want to think about it. And because we don't want to think about it, our minds are getting lazier and lazier by the minute. And the world of AI is making it easier and easier for us to get lazy. Why? Because we can put it in and prompt the computer and we can get all the information that we need. But guess what? In the human world, we still got to respond. We still got to activate whatever we're talking about. We still got to take action. I need to stop right there. See, let me give you another example. The rich versus poor. If you were to borrow $10,000 at an APR of 5% for a year, you'll pay about $500 in interest, which makes your total repayment $10,500. Right? Right? So we're going to talk about personal loans, types of loans. Personal loans. Personal loans are typically unsecured loans. And it varies based on the personal expenses, such as medical bills, home improvements, and interest rates are generally higher due to the lack of collateral. See, when you don't have collateral, it's almost like they're dinging you for not having collateral. This is why you need to have things that you own. And life insurance is a tier 1 asset. You can collateralize life insurance. You don't have to put your home up for collateral. Why? Because if you own life insurance, cash value life insurance, the type that we talk about here at Lifestyle Focused Wealth, our secret sauce to almost everything, it's probably a smarter play to use your policy as a collateral to a loan. That just means if I were to pass away in a short period of time or before I paid the loan back, the lender is guaranteed to get their money back. Number 2, you probably are familiar with this type of loan, a mortgage loan. See, secured loans used to purchase real estate. The property itself is serving as a collateral, and typically it has a lower interest rate because it's leveraging the property. And if you don't pay it, guess what? They take your home. So mortgage interest is all cases. The third one is student loans. So the third one, in talking about student loans, loans specifically for education. And these expenses, they stick with you for a very long time. Some of y'all out there probably still have student loans and been out of school for 25 years. I'm not going to pay it back. You really should pay it back. They also have lower interest rates. That's why people don't want to pay them back. And they may offer some tax deductible interest from time to time. They really do. The fourth one that I want to talk to you about is auto loans. Auto loans are secured loans as well. And this helps you purchase vehicles. But vehicles serve as a collateral. If you don't pay your bill, that's what they do. They take your car. So, which could lead to lower interest rates compared to an unsecured loan. But number 5, let's talk about that one. You got business loans. Yep, business loans. Loans used to finance your business. What do I mean by that? Operation cost, expansion cost, new equipment. Interest on business loans can be tax deductible. That's a business expense as well. So the impact of income tax is where we need to start talking about. How does income tax, or how does it impact what we do, where we get money from? Well, it's simple. Income tax can affect the net cost of borrowing. It can affect the net cost of borrowing because it's allowing deductions on certain types of loan interest. Here's some examples. Mortgage interest deduction. See, a homeowner can deduct interest paid on mortgages for their primary or their secondary home. Many people may not know that. But by reducing their taxable income, give you another example. Again, if you paid $10,000 in mortgage interest and you're in a 24% tax bracket, you can reduce your taxable income by $10,000 by saving $2,400 in taxes, just because you get to write that $10,000 off. Now, to you bigwigs out there, $2,000 isn't a lot of money. But guess what? If it was $100,000, $50,000, $1 million, that same percentage will still be a bigger amount of money that you save in your overall expenditure. And at the end of the day, it makes sense to put it back into your pocket, right? I think so. If you want to put it back in your pocket, put it back in my pocket. Put it back in my pocket. Go ahead and say that down in the comments. So why are we having this conversation? RJ's having this conversation because I want you to know how wealthy people think. I want you to know how other people are seeing the opportunity to borrow their funds. While you're out there trying to make things happen with cash, there are people out there that know how to take these funds and use it. Let's talk about student loans, for instance. If you want to talk about interest deduction, you can deduct up to $2,500 in interest paid on qualified student loans, but it's subject to income limits. But guess what? I can reduce my payment by $2,500. I'm giving you guys some examples where you can just do this thing right there from your seat at home. So if you pay $1,500 in student loan interest and qualify for this deduction, you can reduce your taxable income by $1,500. Now, suppose you were on the cuff of being in a 22% tax bracket and a 12% tax bracket, and you just reduced your income by $1,500. How much money will you have saved? 10% on your federal income tax? Oh, that's a big deal. If you understand what I'm saying, say big deal. Hey, I'm going to take a break, and after I come back, we're going to continue to talk about how these loans look. We're going to talk about business loan interest deductions as well, and how's that working with you? How's it saving with you? And I hope that when you come back, you're thirsty for this information just like I'm thirsty to give it to you. See you soon. Hey, join our lifestyle focus wealth community. Membership starting at $16 a month when you pay the annual subscription. So register online today at www.lifestylefocuswealth.com. Hey everybody, I'm Ronco Johnson, your Lifestyle Focused Wealth Coach. And today we're talking about interest, and we're talking about how wealthy people look at it and how not so wealthy people look at it, right? And what are the differences? And hopefully we're just trying to help you get some ideas to help you save a little bit of money on things that you probably haven't been paying attention to. But let's talk about it on business loans for a second. We talk about business loan interest deductions. And when you have interest paid on a loan for a business purpose, you can deduct that as a business expense. And that business expense helps you to lower taxable business income. That's important. Why? Because your business is already at a static 21%. So if I can just lower the amount of that I need to pay, that's a good deal. That's a good situation, good practice. So for example, if your business paid $5,000 in interest on a loan used to purchase, say, equipment, it can deduct the amount from its taxable income, reducing the tax liability overall. See, that takeaway, the key takeaways from that is interest rates, understanding whether your loan has a fixed or variable rate is crucial to your financial planning. So you want to start getting some idea, hey, is this a variable rate? Is it a fixed rate? What type of rate are we talking about? And see, in tax deductions, knowing the type of loan interest is important to you. Why? Because you want to know, are these tax deductible? And can they help us optimize our tax strategy? Can we reduce our overall borrowing cost? These things are important because if I'm looking at it from that perspective, now I'm able to manage more effectively. Or am I making sense to you folks? Am I making sense to you? You know, again, people with access When they're dealing with access, they're always talking about different ways that they can lower their cost. See, these different loan types, like different types of loans, serve for different purposes. And they come with the varying interest rates. They come with tax implications. Obviously, we know that. But by understanding the intricacies of each one, now we can decide which one of those we need to pull from at what time. What benefits me in my situation the best? So you can make a more informed decision about borrowing and managing your finances. If you have any specific questions, put it in the comments. If you need further details, feel free to ask. You can go visit me at roncojohnson.com, roncojohnson.com, and schedule some one-on-one time and have a coaching session. The first 40 minutes are free anyway. So you might as well get on the phone, call up, and say, hey, let's have a conversation about how I might be able to reduce my tax liability. I think that's worth your time. I feel like that would be worth your time, right? Because if it's not worth your time, then I want to make sure that every interaction that I give you is time well spent. Because we don't want to waste anyone's time. We want to give you access. We want to give you financial knowledge. And our anticipation is that you're going to take this information and start using it and become financially intelligent. And you're going to make better decisions faster. And you got to remember, just like AI is teaching everybody how to prompt a computer, you are the human computer. You are the human computer. Your brain can help prompt you to action. If we can prompt a computer, prompt you, the person, the human computer. All you got to do is tell yourself to be stronger. Type it up. Be stronger minded. Start making stronger financial decisions. You can tell yourself, rid myself of the weakness. I don't need to shop for things that aren't going to make us more money. I might need to put money back in my banking system. I need to reprogram those bad habits. Just like you use ChatGPT. Well, if the color comes out blue, you can say, make it a lighter blue. Or matter of fact, get rid of the blue and turn it to purple. You can make these changes in your human computer too. And all we're doing is helping you reassess, realign, and then start moving forward. Hopefully we're making sense. So we're going to talk about the three types of lower loans that are unsecured, right? Unsecured loans. See, I want you to think about this for a second. What about loans from cash value? Loans from HELOCs? Loans from margin accounts? When we start talking about the intricacies of how these loan interests work, these types of loans are available. And the impact of this on your income tax, providing examples to illustrate the differences, can be monumental. Because loans on cash value, HELOCs, and margin accounts are income tax free. But first, let's talk about cash value loans. Life insurance cash value. See how it works is, the cash value loans are taken against the cash value of a life insurance policy. And the cash value accumulates over time as you pay premiums. This allows you the opportunity to borrow against the amount without needing to qualify for any other traditional loans. It's something that you completely own. And the interest rate on cash value loans is typically lower than unsecured loans. A lot of people don't know that. All they saw was the interest rate. However, if the loan is not repaid, then the outstanding loan amount plus interest can be deducted from the death benefit. And what I mean by that, say you had $1 million policy and you didn't pay your loan back. They're going to take the money off the death benefit when you pass. Okay? So no, you're not going to get $1 million. Maybe you get $900,000, depending on how big your loan was. Okay? But the tax impact to that, see, the interest paid on cash value loans is generally not tax deductible. However, the loan itself is considered taxable income unless the policy lapse. And I may have said that backwards. It's not considered as taxable income unless your policy lapse. Let me make sure I rephrase that. Okay? So for example, if you're having a life insurance policy with a cash value of $50,000, you might be able to borrow up to 90% of that amount. And if the interest rate was 5% annually, and you borrowed $10,000 out, you would only owe $500 in interest over the course of that 12 months. That's how that works. Home equity lines of credit, or HELOCs, they work like this. The HELOC is a revolving line of credit, but it's secured by the equity in the home that you live in, your primary residence. It typically has a variable rate. And that variable rate is an interest rate and a draw period, usually of 10 years. So doing what you could take money from it, or you could take a loan from it and borrow from it, followed by a repayment period. And that repayment period typically is up to 10 years, right? So how does the interest work? Interest rates on HELOCs are generally lower than unsecured loans because they're secured by your home. See, during this period, you may only need to pay the interest on the amount that you borrow. And you may not pay the money on the principal. See, these are just things that you need to know. You can make the payment on the interest and the principal, or you can start making direct principal payments. How many of you guys knew you had these options? How many of you knew you had these options? Put that in the comment. Put options in the comment. Am I losing you? Am I putting you to sleep? Am I giving some detail that maybe you can find this useful? Are you finding this useful? Are you finding this useful? Because I want to make sure you're getting it, right? Because on the HELOC, here's where the tax impact works. Interest on a HELOC can be tax deductible if the loan is used to buy, build, or improve a home that secures the loan. So if you want to put new floors, or you want to make a kitchen bigger, or you want to expand the backyard, you got this option. So for example, if your home is worth $300,000, let's say that, and you owe $200,000 on your home, that means you have about $100,000 of equity that you could touch or have access to. You might be able to get a HELOC for up to 80% of that $100,000 of equity, which will be about $80,000. So if you borrowed 20 of that 80,000 at an interest rate of 4%, yes, you would be expected to owe $800 in interest annually. However, you've used that money to increase the value of your home. That's not a bad deal. Maybe you expanded your kitchen. Maybe you added some square footage. Maybe you put something, another bedroom or a bathroom, and completed downstairs that was already done. You created more value in your home. All right. So let's talk about margin accounts. Just really briefly, margin accounts, they work like this. They allow you to borrow money from the brokerage firm that you're working with. Usually, you're using your investment portfolio as collateral. See, this type of loan is often used to purchase additional securities. However, the interest rates on margin loans vary, but they're typically lower than unsecured loans. However, if the value of your investments start to fall, be careful, because you may face what is called a margin call, requiring you to make more of a deposit for those funds or to sell some of your funds to cover the loan amount. So ideally, what I am saying to you folks that may not have a margin account allows you to own some stocks, but you're borrowing against it as collateral without selling your stock. So your stock is able to go up as well as it goes down. And you've borrowed money from the brokerage firm itself. And it varies, okay? So the impact of that is that interest on the margin loans can be tax deductible if borrowed funds are used for investment purposes. See, the deductions is limited to your net investment income. So what I mean by that is if you have $50,000 in a brokerage account, you might have borrowed up to $25,000 on your margin. Now let's just say your interest rate was 6%. You would owe about $1,500 in interest annually. So if you use the loan to buy more stocks, the interest may be deductible against your investment portfolio or your investment income. Did you know that? Did you know that? I'm hopeful that I'm giving you some powerful secrets of the wealthy today, because the key takeaway here is, number one, interest rates, secure loans like HELOCs and margin loans generally are lower interest rates compared to unsecured loans. Number two, tax deductions. When we talk about tax deductibility of loan interest, it varies. HELOCs interest can be tax deductible if you use the home for improvements, while margin accounts, the interest can be deductible if you're using the loan to buy more investments. See, once you understand the intricacies of these things, then you start to figure out, oh, okay. Well, if I got $100 worth of stock, and they're going to allow me to use $400 worth of stock, and they're going to charge me 7% a year. Well, if I go ahead and buy more stock, if the value goes up, well, that interest at 6% interest a year, I'm going to be able to write it off because it's tax deductible. Because I invested in more stock. See, isn't that powerful? I just want to make sure that we understand that we're talking about power moves that can substantially set you apart. And when you start to understand understanding these intricacies that we're talking about, it can help you make more informed decisions, especially when it comes to borrowing and managing your finances. Okay? Am I giving you too much? Am I giving you too much secret sauce today? Am I? So, there's so much things that we could talk about. You know, I like giving the insight of these advantages that wealthy people have over poor people managing loans and interest and tax obligations, simply because here lies in their access to resources, and once again, and the financial strategies that can significantly reduce your cost and tax liabilities. This disparity creates what we call the pivotal moment. It's pivotal. And it helps you to start understanding that there is some economic inequality happening here. But you don't have to be on the side of being taken advantage of. You can change that. You can change that just because, just like I said earlier, your brain is the human computer. And because your brain is the human computer, I know that you can start making changes right now. I know that if you want to make these changes, all you have to do is sit down with a professional. Hey, see that right below? Go ahead. Make your phone call. Sit down with someone, a financial expert, financial team that can plan to meet your unique needs and goals. This is what it's all about. It shouldn't be a scary proposition. This proposition is available to you. We're making this information available to you. And being able to make it accessible for you to get access to could change the perspective, could change your perspective, can definitely change the trajectory of your financial life. As I said earlier, our firm, we don't sell policies, we're selling legacies. This is empowerment, folks. That's what we're here to do. Give you economic empowerment so you can make better financial decisions to help you grow. That's what my motivation is all about. Is if I can help you optimize your financial strategies, along with my team of experts that can help you identify the best ways to minimize your tax liabilities and manage your debt more efficiently, how valuable is that to you? How valuable is that? You should be probably first in line talking about that's extremely valuable, especially if you're a high net worth individual. So the fourth investment leverage, we're talking about leveraging investments. So wealthy people can use their borrowed funds to invest in high return opportunities, which further increases their wealth. For instance, they might use loans on the margin account to buy additional securities, but like I said earlier, it helps to benefit their investment returns as well as their tax deductible interest. So it's taking you up and bringing your tax liability down at the same time. Is that good stuff? Is that good stuff? See, let me give you another way that you could start to leverage these funds. I just want to give you one more, because I don't want to give you guys too much, because what happens is you start getting really, really smart, and then you start figuring out that I don't think I need a financial expert. Well, the truth is we always do. As we're coming down to the end of our program today, I want to share with you this. The wealthy often leverage varieties of financial products that maximize their wealth. It helps to minimize their taxes. It helps to manage their risk. And the closer and closer that we look at it and how they do it, we start to figure out loans and credit, mortgages and HELOCs. Wealthy individuals use mortgages and equity lines of credit to finance their real estate purchases. And real estate is an investment. So that makes that qualify for tax deductions. The interest is tax deductible because it's an investment. And they benefit from low interest rates and potential tax deductions on those interest payments. See, margin loans, they also borrow against their margin loans, their investment portfolios. If their portfolio started out as $100 and it's now worth $1,000, they have the ability to borrow against that. So they can purchase additional securities, which amplifies their investment returns. It makes it go up. And when you really think about it, the interest on these loans is often tax deductible because they reinvested into something for the purpose of investing into the security, right? Number two, the tax advantages on these accounts, when you maximize contributions to your retirement accounts like your 401k and your IRA, they offer some tax deferral or some tax-free growth They also have like the health savings account, HSAs. They have tax-free medical expenses, brokerage accounts. We've talked about what wealthy investors diversify their portfolios across what stocks, bonds, mutual funds, and other securities. So they use this strategy like tax loss harvesting that we've talked about in the past. We can't forget some of these tools that we're talking about, folks. Why? I need you to use them. I need you to use them every single day. I need you to intertwine some of these concepts and strategies in your everyday lifestyle. Use these strategies like this loss harvesting to offset capital gains with losses and reduce your tax liability. Use insurance products like life insurance, permanent life insurance, such as whole life and universal life. They both accumulate cash values that can be borrowed against. Just make sure you sit down with your advisor, your agent, to find out what type of policies we got, because these provide you a tax-free source of funds that can be used in your estate planning efforts. And that's all we really are saying. It's not about one versus the other, one's good and one's bad. It is about having a unique understanding of how all of these things work together, and you having a system, a strategy of how to use these concepts in an intelligent way, a more informed way. Even when we talk about annuities, these provide steady income streams of income in your retirement years. They can even offer tax-deferred growth. They are often used to ensure a stable financial income. We've talked about real estate. We've talked about real estate investments because the real estate, wealthy people use it as a way for rental properties or commercial real estate or development projects. See, real estate can be a steady source of income as well because it has multiple tax benefits and it appreciates most of the time over time. Okay? So if you're investing in REITs or real estate investment trusts, allowing them to invest in real estate without you directly having to own properties, that's just another way of offering liquidity and diversification to your portfolio. And you can do all of this at the same time. And last but not least, business ownership, private equity and venture capital. Investing in private companies or startups can help you yield returns. So if you find one of these startup companies, even like our company, wealthy individuals may often participate in markets to diversify their investment portfolios. Why? Because they believe in you. They believe in your concept. They believe in your strategy. So no business is a crazy, stupid, dumb business. You just may have to be able to articulate it well and make yourself and build your business in an investable type of way. These strategies and tax strategies for the business owner, it can help take care of advantages such as tax deductions and credits such as depreciation on assets, business expenses, and tax incentives that you definitely want to use. So the last on our list tonight, and then I'm going to let you go until next week, we're going to talk about more things down the road that I hope that you're going to be able to put into play. But our number 6 is tax planning. The truth about trust and estate planning, because the trust can be used to manage and protect and minimize your estate taxes. And it ensures that your wealth is transferred the way that it needs to be, according to your wishes, no one else's. It allows charitable trusts to be set up so you can also provide tax benefits while supporting your philanthropic goals. But if I want to make sure that the things I care about continue to receive funding from my trust, I can designate that. And see, these are tax-exempt investments. Municipal bonds and other tax-exempt securities offer interest income that is not subject to federal and sometimes state taxes. I'm going to give you one more scenario and then I'm going to let you go. Imagine a wealthy individual with a diversified portfolio. And they might use a HELOC to finance their new real estate investment. They may have borrowed on a margin to buy more stocks and contribute maximums to their retirement accounts. So they also have what is called whole life insurance that has a significant amount of cash value stored away in it, which they can also tap into for tax-free loans. Additionally, they can invest in private equity and use this trust to manage their estates and reduce their overall tax liabilities. See, by leveraging all these products strategically, the wealthy can enhance their financial situation, their stability. They can grow much faster, grow their wealth much faster, and reduce their tax burdens, which reduces their stress outlet. If I've made sense to you today, please, if you feel like you want to have the conversation with us, do me a favor. Stop waiting. Go ahead, schedule some time, have a one-on-one, and allow either myself or our team to help you. It's that simple. Stop trying to figure it out on your own. Go to roncojohnson.com if you want some coaching. Let me know. Or you can just simply stay with us right here and subscribe and watch our YouTube channel for more tips that you can use building your financial strategy from the ground up. And the only thing is you have to spend some time. You have to spend some time. And I'm hopeful that it's time well spent because we don't want to waste your time. If this has been useful for you or this information has been information that you think your friends, your family, your business owners will like, please let us know in the chat. Send us an email, reach out to us. I love hearing your stories. And if this has been an impactful conversation for you, hit like, share, and subscribe. And we'll see you next time. If you join us right here on Lifestyle Focused Wealth, I will look forward to seeing you at the top. But thank you for your time. I'm Ronco Johnson, your host, and I'll see you next Friday right here at 1 o'clock. See you next time.